Most traders rely on order blocks to predict the price, but what happens when those order blocks fail? That's where one of the most overlooked yet powerful strategies comes in, the breaker block. It flips failed zones into high-probability setups, catching traders on the wrong side and positioning you with smart money. If you've ever wondered how to turn losses into opportunities, this strategy is the key. By the end of this video, you'll know exactly what a breaker block is, the psychology behind it, how to identify valid breaker blocks, how to build a complete trading plan around them step by step for consistent results. If you are interested in learning advanced trading concepts, proven strategies, precise entry techniques, and the psychology needed to stay disciplined throughout your trading journey, make sure to hit the like button to show your support, and don't forget to subscribe if you're new here. An order block is simply a price zone where institutions place large sell or buy orders, creating areas of supply or demand, to move the market in their intended direction. But sometimes, that zone doesn't hold. A breaker block forms when an order block fails. For example, a bullish order block pushes price higher, traders enter long, expecting continuation, but instead of holding, price breaks back down through it and closes decisively lower. When this happens, the failed bullish order block transforms into a bearish breaker block. It signals that the previous demand has been absorbed and that sellers are now in control. The same works in reverse. If a bearish order block fails and price breaks through to the upside, it flips into a bullish breaker block. This happens because traders who entered on the original order block are now trapped. Breaker blocks are powerful because they don't just mark failed structures, they expose where traders are trapped, where liquidity has shifted, and where the smart money has flipped direction. The most important thing to understand is not just the pattern itself, but the psychology behind why they form. When an order block appears, most retail traders assume it will hold as a strong level of support or resistance. They place their buy or sell orders around it with confidence, expecting the market to respect that zone. But institutions know this behavior very well. They intentionally drive price through that order block to trigger stop losses and trap liquidity. This moment of failure is what creates the breaker block. On the surface, it looks like the order block didn't work, but in reality, the failure is part of the smart money's plan to collect liquidity. Once enough traders are trapped on the wrong side of the market, institutions then reverse the price in the intended direction. This trap works because of the emotions involved. Retail traders see their stop loss get hit, panic, and often flip their position, believing a new trend has started. Meanwhile, institutions are simply using that liquidity to fuel their own trades. Fear and greed drive retail traders into making emotional decisions, while patience and planning allow smart money to profit from those very mistakes. So the psychology behind breaker blocks is about understanding who is being trapped and why. Breaker blocks reveal the true intent of smart money, to manipulate retail expectations, gather liquidity, and then move price in the opposite direction. Once you start to look at breaker blocks from this psychological perspective, you'll stop seeing them as failed patterns and start recognizing them as one of the clearest confirmations of institutional activity. Not every failed order block automatically qualifies as a valid breaker block. Many failed zones are nothing more than market noise or weak reactions that lack institutional intent. For a breaker block to carry real significance, specific conditions must be present. Now, let's break down the rules that will help us identify a valid breaker block with confidence. Before a breaker block can form, the market must first sweep liquidity. Liquidity refers to the pool of stop-loss orders or pending orders resting around obvious price levels, such as equal highs, equal lows, or prior swing points. For example, when a bearish order block develops, price often pushes below a previous lower low to grab sell-side liquidity. This manipulation clears out traders who were positioned long too early. Once liquidity has been taken, the next condition is a decisive break through the order block itself. A valid breaker requires clear candle that closes beyond the order block. Wick rejections are not enough, you need a full body close to confirm that order flow has shifted. A valid breaker block also tends to align with market structure shift. This is often called a break of structure or a change of character. For example, if a bearish order block fails and flips into a bullish breaker block, price should not only break back above the order block but also take out a previous swing high. That market structure shift confirms bullish intent. Finally, look for signs of momentum and inefficiency in the new direction. One of the clearest signals is the formation of a fair value gap. A fair value gap, or FVG, is an imbalance left behind when price moves so aggressively that one side of the market fails to trade, leaving a visible gap between consecutive candles. When a breaker block forms alongside a fair value gap and strong momentum, it confirms that smart money has decisively rejected the old level and is driving price in the opposite direction. Once you've confirmed a valid breaker block, the next step is planning and managing the trade with precision. For the entry, the safest approach is to wait for price to return and retest the breaker block zone. At that point, zoom into a lower time frame, such as the 1-minute or 5-minute chart, and look for a change of character or a break of structure. These signals confirm that momentum is shifting in line with the breaker block, giving a higher probability setup. Open by position on slight pullback after confirmation. For the stop loss, always place it just beyond the breaker block with a small buffer. This protects you against false spikes or wick hunts while still keeping your risk tightly controlled. For the take profit, the first logical target is the nearest liquidity pool, for example, equal highs, equal lows, or a recent swing point where stops are likely resting. This is your TP1, a partial exit that locks in some profit. From there, look to the higher timeframe key levels such as strong support, resistance, or supply and demand zones for TP2. This layered approach allows you to capture both the immediate reaction and the larger directional move. By managing the trade this way, you secure profits early while keeping part of your position open for extended runs. It's about balancing safety with opportunity, banking gains while still giving the market room to deliver a much bigger move. Even with a solid plan, you will still face losing trades. That doesn't mean your analysis was wrong, it simply means not every setup plays out. Always backtest before risking real money. Track your results, refine your strategy and build confidence in the setup. Stay consistent, and over time you'll see the results. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.